Hello, and welcome to today's webinar hosted by Left Brain Professionals. I'm Suzanne Camden, and I'll be your host moderator today. If you need help at any time, you can email us at support@leftbrainpro.com, or you can use the chat function within the Flow platform. It's in the upper right-hand corner. So let's go over a few housekeeping items before we start. Today's webinar is hosted on the Flow platform. You should see a small toolbar with 4 icons in the upper right-hand corner of your browser window. The first button will mute the audio. The second button will put the webinar in a full screen mode. The third button enables chat and QA, and the fourth button enables the settings. Please enter your content questions in the QA panel at any time during the presentation. We'll address as many of your questions as we can. Use the chat feature to chat with hosts, presenters, and other attendees. Please do not enter your content questions in the chat panel, as they may get lost among many other conversations. If you have connection or audio issues, please try the following solutions. Turn off your VPN, or test your system using the links that are provided. You can also exit and re-enter the event. You can try a different browser. You can connect from your own personal PC, phone, or tablet, and you can reach out and contact Flow support. In order to receive credit for today's presentation, you must respond to 3 of the 4 polling questions. Certificates are generated automatically and will be emailed within 48 hours after completion of the webinar. A survey will display in your browser at the end of today's webinar. Please take a few moments to answer the questions and provide any feedback. The recording of today's presentation will be available on your YouTube channel, and the link will be included in a follow-up email. Thank you for your attention, and without further delay, I will turn this over to Steve for today's content.
Okay, good morning. I hope that everyone can see the slides and hear the audio. I know Suzanne covered a couple of options if there is any issue with that. So we will go ahead and dive right into today's topic, which is managing indirect rates. We only have an hour today, so I'm going to try to get through quite a bit of content, which is why we asked that Suzanne will monitor the questions, and we will, time allowing, discuss some of the questions together as well. Okay, so a little bit about Left Brain Professionals. We are a boutique accounting firm that services government contractors specifically. Now, we will work with businesses seeking government contracts or preparing to have government contracts, but we specialize in accounting systems, strategic services, and compliance. Our practice areas, which we alluded to: accounting system design and implementation, monthly accounting support packages that do include that compliance aspect of the DCAA and FAR guidelines, and then the strategic services, CFO, controller, as well as DCAA audit support.
Hey, Steve, it's Suzanne here.
Yes.
I hate to interrupt you.
No, go ahead.
They can't hear anything and that they don't have any sound.
There are sometimes that is related to some of those issues that you went over in the introduction, potentially switching the browser or exiting and re-entering the event. I would like to confirm that majority of us can hear. I do see that Mr. Chavez said that his sound is functional.
And Erica and Amanda and Lauren.
So I'm hoping that a majority of our attendees are able to view and hear.
Okay. Sorry for breaking in on you.
The Flow support should be available as well to potentially assist in helping out with any technical issues. I
Okay.
know I am in Microsoft Edge. Chrome is another one that has been widely regarded as acceptable.
Yes, I see people over here on Edge and Chrome. All right, well, we'll try to get Zoe fixed up and you just go ahead.
Right, and the content and recordings will be available. If you truly cannot hear, hopefully when you download the recording that you will be able to enjoy and benefit from our presentation today. So this is our team. This is me in the middle and Suzanne that are with you today. And our firm principal is Robert Jones. He does an extensive amount of training and speaking. So some of you may be familiar with him or have heard other topics in our series this year. So we have 3 learning objectives today for managing indirect rates. Identify the causes of rate variance. Explain the impact of over and under billing costs. And finally, to describe the importance of managing indirect rates. So with that said, I believe we are to our first poll question, which I will go ahead and launch that. This one here, we're just getting a little feedback what your existing processes are on your indirect rates. So I have launched the poll.
So our first poll question, Steve, it says, do you have a process for managing your indirect rates? So let's see, where do those, Steve, you must be the one who can see it. Oh, there they are.
Yeah, we have a very large percentage of our attendees have responded. We'll do about 5 more seconds, and then we will see where our results have landed. Okay, so I have closed, I believe. Let me make sure here. Stop the poll, and I'll return to our slides here. Oh, pardon me. It looks like most of you do have a process in place. So we'll go ahead and dive right into section 1. Managing indirect rates. We have 2 primary goals: maximizing profitability, which that includes, realizing if you have a fee percentage of 8% and you're only realizing 5%, then there's some profitability there or some assigned profit margin in the contract language that you may not be fulfilling. And then the limit of the over and under billing to the government, that goes back for the folks that have those cost type contracts and submit the incurred cost proposal 6 months after your fiscal year end. You want to make sure that your final incurred costs tie back and that you have not over or under billed, or that in your multiple year award that those over or under billings may level out before you start, sending more money or giving people credits. You do want to make sure that any over or under billing is not simply a front or rear heavy performance measure. So maximizing profitability. We get this call often from our clients. They're not making enough money, or like I alluded to, we have an established fee of 10% and we're only realizing 5, 6, whatever the case may be, or they're not realizing any. Nobody really calls us and says we need help carrying all this money to the bank, which makes sense. Maximizing the profitability by monitoring the budget and the billing rates. These points here speak directly to not only having a compliant and acceptable method for calculating your indirect rates, but doing that regularly, monthly, as you close your books. monitoring those budgets and billing rates, not just at the end of the year or during the incurred cost proposal, writing a budget specifically to a proposal. These are all things that can help out to make sure your existing rates, you may be bidding on a very large contract that changes your rates, requires new staff members, additional fringe, much more direct labor. If these items are not in your budget and you're calculating your pricing rates based on your historical indirect rates, you may not be allowing for all those potential costs of a new contract to be factored into that pricing point. So that for the maximizing profitability, not only to perform these exercises, but to do them frequently and regularly so that that data has the value and the feedback that is so valuable. Limiting over and under billing to the government. We will get into that more in the rest of our slides, but that goes back, you want to make sure that if you're in an over or under billing to a material level, that is enough trigger right there to question, is our pricing right? Are our rates calculated accurately? And obviously firms like Left Brain Professionals can help you confirm, monitor, and dig into that in very specific detail. So what are some causes that would result in our rates changing or having variances? So the first one here is a fluctuation in direct work. Obviously, if your direct labor is increasing or your utilization of your labor towards direct is increasing, then those indirect labor amounts are most likely going to decrease. Like overhead and direct are pretty closely related. If your direct employees are idle, they're probably recording that time to overhead. And if they're super busy and don't do any overhead, that's obviously going to have a direct effect on the calculation of indirect rates. Budget overruns. Say we made a budget for 2022 back in October, November. We did a multiple top down, bottom up. We looked at the history as well as our forecasts. But if we're not monitoring and tracking rates and our budgets, we may go way off of the budget. And it is perfectly okay to update your budget throughout, maybe not monthly, but quarterly or semi-annually, to take another look at that existing budget and make sure it is on track, or that you don't have additional information that could more accurately predict some of those costs. Labor efficiency. This is closely tied to, like I said, the utilization, direct or indirect, and also not just the efficiency of you losing your labor, but is it, do you have your total timekeeping? Is your labor distributed properly? Are all of your labor dollars split between your appropriate cost pools? Is all of your direct labor tagged, to those final cost objectives, whether it be a CLIN or a contract or a customer? And then your unallowable costs as well. Those are unreimbursable expenses that are not factored in to the rate calculations except for in the bases, which I will get more to the unallowable costs and their effects on these rate calculations further into our presentation. So fluctuation of indirect work. I kind of went into this a little bit from the introduction slide, but direct costs are the largest amounts in the bases of fringe, overhead, and G&A. When you're putting those direct labor dollars into your bases, that's where you're allocating those indirect costs And so obviously the direct costs drive a lot of these calculations. Winning an unexpected contract, losing an unexpected contract, delays in an award. Now, with the DCAA, there's often some delays where, you need to send them a letter and they need to respond with a notice to proceed or an approval of your provisional rates. Now, I think if you have been contracting for a while, you are very well aware this could be months. It's not just a matter of days or a phone call. It could take multiple months for them to reply or to field, confirm some of these processes, which speaks to calculating regularly, using those budgets, updating budgets. Stop work orders. All of these things can have a very considerable effect on your direct labor, and that changes in direct labor are probably going to have the single largest effect on the indirect rate calculations. Budget overruns, our next topic here. This one, obviously, your budget may not have been as accurate as you anticipated. The direct budget overruns may result in unbillable cost, exceeding the cost ceiling, reduced profit margins, fixed price contracts. You are agreeing, at that fixed price to complete the work. And if your fixed price budget or proposal was not accurate, you are going to get paid what that fixed price agreement was, but you still have the obligation to complete that task in the award. So there is a risk there, obviously. Fixed price, the contractor is taking on a little more risk that the fixed price, there may not be any more money to give. Even if you have a legitimate overrun, that obligated budget may not have room for that sort of fluctuation. Indirect budget overruns may result in increased rates, underbilling, or reduced profit margins. These all go back, the quality of your indirect rate calculations, the accuracy, the budgeted proposal rate calculations in relation to pricing. The more accurate these are going to really work directly towards eliminating those pitfalls, underbilling, not realizing determined profit margins or fees. So now we have another poll question. Let me launch that, and Suzanne will have an opportunity to present that for you.
Can you hear me, Steve?
Yes, I can.
So here's our next poll question. Which of the following is not a cause of direct work fluctuation? Winning unexpected work, too much indirect work, delays in award, or losing an expected contract?
So we'll give you guys 20 seconds or so to reply to that. And while we have a moment, Suzanne, can you see the actual responses?
Yes, I can.
Okay, I cannot. So if you could just give our group a little bit of information towards where this question is going.
We have 28 votes in at this time. We have 11, it's all over the board. We've got 11% are saying winning unexpected work. We've got 68%, so the majority say too much indirect work. 7% say delay in award, and 14% say losing an expected contract. So what's the real answer, Steve?
So the actual answer is too much indirect work, the second option there. And that goes right back to the slides. Winning unexpected work and losing expected work were directly related to those direct work variances. And the delays are going back to when we talked about the DCAA may not be as prompt, or you may receive a stop order. So those were some of the things that we specifically mentioned. Too much indirect work, that is really going to affect that actual rate calculation. And that speaks right back to the fluctuation in direct work, because with a set amount of employees, that goes to the utilization. If there's a lot of indirect work, by turn, there's not, or a decrease in direct. So I'm going to go ahead and stop this poll, and we will get right back to our content here. So labor efficiencies, I related to the poll, we started to talk about the utilization. Budgets and rates are built with an assumed labor efficiency. Increased efficiency reduces indirect rates, as decreased efficiency increases rates. So to simplify that with a little visual here, direct costs goes up, indirect costs go down, and vice versa. This kind of is right in line with our first section that we've gotten through. If you're doing lots and lots of direct work, that is, your cost of sales, your billable work, that is going to positively affect your rates by lowering your indirect. And I shouldn't say positively, because there is no right or wrong answer. The numbers are what they are. If you're reporting in compliance, your accounting system is adequate, the rate calculation is simply a matter of putting the actual costs into these appropriate places. But with that said, the more direct work you're doing, the more billable work you have, that speaks very well to profitability and revenue. So unallowable costs. These are the costs I think we've covered in some of our previous monthly webinars. But unallowable costs, not things you are not unallowed to buy. They are things you are not allowed to bill the government, things the government will not pay for, and are often removed from the indirect rate calculation, which there is a footnote in the bases. And that's our second note here. Unallowable direct, fringe, and overhead cost follow the same treatment as allowable. So what that is saying is not that we put them into the pools, but if they are in a causal beneficial relationship for the rate calculation, they can be included in the bases. Some unallowable costs from direct, fringe, and overhead are in the bases of fringe, overhead, and G&A as appropriate. And these amounts that are added result in unrecoverable indirect costs. And that's okay. It is definitely required by the FAR guidelines that the unallowable expenses be identified, separated from all other indirect expenses within the accounting system. So this is a little bit complex, a little bit, we say one thing, unallowable costs will not be reimbursed by the government and are removed from the pools. But with that said, because of the relationship to the pools in the bases, those unallowable costs can be included and should be included. And we will have some examples later in our presentation to kind of visualize some of these concepts. I want to take just a moment and see, Suzanne, if there have been a lot of questions. It looks like a lot of the chat is related to some of the technical issues.
Yes, the only chat that I've seen lately is, I haven't seen any on technical issues for a while. So
Okay. So yeah, just making sure. I encourage you, to type your questions in if something does pop up so that we can address that while it's fresh in our minds. But getting back to our content, we have over or under billing. Now, we've talked a little bit about this already, but final rates are determined after the submission of the incurred cost proposal. Now, I briefly mentioned that is kind of the tax return for a government contractor. 6 months after your fiscal year end, they are required, if a contract requires it, or if you're performing any cost type contract awards, the incurred cost proposal, which is basically submitting exactly what your actual costs were to basically verify your rate calculation, your pricing point, as well as to ultimately determine that over or under billing amount in line with the contract. So this requires evaluation of adequacy, time to review and finalize the results. And in some cases, if they are not satisfied, whether it be a compliance issue or just a material amount of over or under billing, this incurred cost proposal can trigger or require that they want to take a closer look and potentially perform an audit, assess the adequacy of your accounting system. But all of this goes back to the importance of managing these indirect rates. Because if you've compliantly and accurately calculated these rates, the over or under billing, it can never be eliminated, but can certainly be minimized to where it is much more manageable. Continuing with over and under billing. Overbilling. Significant overbilling may result in an immediate cash payment, often difficult for small businesses. So I think this is kind of understood with the government. If you overbill them, they have the right and are able to say, we want some of our money back. On the other side of that coin, if you don't bill them enough, they're not going to yell too loud. Underbilling may result in a lack of additional funds, delays in funding modification. But if you're underbilling them, just like in your personal life, the customer or the government isn't going to complain too loud, but that could also be a sign of, lack of adding to your work or their confidence in your work, delays in modifications, renewal of option years. If they identify a problem, it's never really a good thing. So that really both of these topics, whether over or under, the better, more accurate that your rate calculation and pricing, wrap rates and cost multipliers are, the more that these two situations can be eliminated. And there's obviously negative connotations to either way of a sizable amount. And then process. Monitoring reports, evaluating variances. I really want to stress, calculating these rates monthly, definitely on a year to date, but, as of April 30th, as of May 31st, as of June 30th, you want to close those books monthly, have that accurate, reliable financial statements and close process so that you can benefit and really utilize the analysis that's provided from the rate calculation. So a little bit more on evaluating the variances. Identify and understand the root cause. we find people do not investigate the variances or cannot adequately explain the root cause. And if you can't explain the problem, it's very difficult to fix. And that goes back to our common client calls. They may be veteran, long-time experienced contractors, and they just can't determine if we have a profit margin of 10%, why we're getting 5. And that often goes directly to the rate calculation, the understanding of what builds up your bases and your pools. So the process of not only tracking the rates, but ensuring that they're compliant and accurate is all part of this reoccurring process. We've got our third poll question here, which I will go ahead and get that launched.
Okay, so our third poll question is, how often do you monitor your indirect rates? Is it rarely, monthly, quarterly, or annually? Gosh, Steve, I guess that probably depends for everybody on how easy it is to do it.
Right. And we, going right back to the adequate accounting system, one of those points is monthly close of books.
Mm-hmm.
And if you are closing your books monthly, reconciling some of those balance sheet accounts and getting reliable financial data, I think calculating those indirect rates at that same schedule is a very good practice.
So monthly seems to be the front runner at 62%, but
wonderful.
Rarely, quarterly, and annually are all pretty much the same. So it looks like everybody's doing it a little bit different.
And there is, at the end of the day, if you, even as a government contractor, if you're only performing fixed price work or some T&M work, you may have not had a requirement to actually calculate, compliant indirect rates. Now, we would encourage any contractor, regardless of the requirement or the contracting activity, to be aware, just, for your industry, your competitors, your pricing, to actually keep an eye on those rates, whether you are required to or not. I will go ahead and close our third poll question here. And get us back into our slides. So moving right along, these are, and I do hope that these slides are large enough. These are from what is called ICAT Systems. It is a government contract specific integration that works with QuickBooks Desktop. It's an XML real-time connection to the QuickBooks financial data, and you establish what your pools and bases are, and it calculates your rates with no work. External template, no need to manually to build this. You simply have this, and there is an annual fee for that specific application, but that's just a little background. Now, this is a summary rate calculation where it's simply going to show the final pool total, the base total, including allocations, as well as those calculated percentages. Now, that's going to give you the numbers. It's going to show you that wrap rate or cost multiplier. But moving into our next example are examples of detailed reports. So here we are seeing for each cost pool, the individual expenses that build up the pool or the denominator, then any allocations, if we're adding fringe on labor, is going to be laid out, getting us back to that pool total. And then the base, we're going to list on our detailed report, which this could be in Excel. This, just because this ICAT platform is available, it's a good visual example. But then on the base, it's going to detail what items, what allocations are making up the base to determine the rates, and then can help, whether it be an external, internal, a DCAA representative, to really understand and see how those causal beneficial relationships are established and the compliance. So you can see, I think this first one is fringe, where you've got the cost of your staff, W-2 employees allocated over total labor. And then overhead and G&A, and excuse me, because I actually cannot tell which one of these are which, but what I want you to see as attendees is the detail of these pools, bases, as well as the allocations. And there is no one set, fringe base normally is labor dollars, but it can be hours. It can be, there is not one compliant method. Same thing, overhead. In a manufacturing case, sometimes we will include direct materials. In a service company, it is just direct labor in the base of overhead. And then G&A with a total cost input, that's where we're adding back that fringe, direct, and unallowable overhead into the base, basically allocating those administrative indirect expenses over all the costs of the business. And we're not here to talk about, the fundamentals of indirect rates, but that is kind of a widely accepted service-related organization calculations and base methodology. So this is a continuation of the detailed reports here. And like I said, I apologize because on my monitor, these are not super large. But what I want to draw your attention to on this slide is not only do we have the calculation of the actual indirect rates, but then we have at the end here that direct labor, the wrap rate, which the wrap rate, if you think back to your college statistics courses, is the combination of all three of those rates. In this example, we have one fringe, one overhead, one G&A, and then the wrap rate or cost multiplier is the combination of all three. So the actual mathematics here, if you're interested, is 1 plus fringe rate times 1 plus overhead rate times 1 plus G&A rate. And that gets us back to this wrap rate or cost multiplier, where we can say for every dollar of direct labor with our indirect expenses and calculated rates, we need to burden that amount. In this case, the wrap rate, I believe, is 1.8. So for every dollar, you need to bill $1.85 to get that total cost recovery or break even. And this does also factor in if you have a fee, or a profit margin, which are synonymous terms. So this here is the rate variance report from this same indirect rate platform. This is very specific to government contractors. It's an annual subscription. But what we're seeing in this report that I have as an example is it's looking at each of the individual projects, whether that be a contract, a commercial customer, a contract line item number, or task. What it's doing, it's got the direct costs that are incurred directly, cost of sales, and then based on those calculated rates, it is allocating the indirect costs so that your job profitability is factoring in all those costs, not just the direct portion. Like in QuickBooks, a Xero, some of those accounting softwares, they don't allocate costs within the system. So to get that accurate report, not just what are my direct costs compared to my invoicing, you get that indirect rate calculation factored in. And then the variances and calculations here are giving you the feedback of those unrecoverable costs, those unallowable costs that should be identified and separated in the accounting system. These variance reports will help you determine what amount of unrecoverable costs you may be incurring. And there's always, you can't control the rates, but you can manage them as effectively as possible. So our next section here, it looks like we're right about on schedule as far as time. Correcting variances, adjust spending quarterly, realign line items within a pool, or realign dollars between pools. So this is speaking back to, as you analyze your budget and you manage your rates each month, you may see if you have a single overhead, there may be some pricing issues. If you have multiple divisions with very different costs, there may be some created variances in your calculations. Or you may look at items within the pool and simply determine, that is not the appropriate or compliant space for them in those calculations. The goal of this adjustment is to match your cost billing multiplier regardless of individual rates. So what you're actually billing, what you're invoicing, whether it be monthly progress payments, in an ideal world, your rate calculation and your cost multiplier would tie back to your actual pricing or your agreed to labor categories in the original contract. So that is the kind of the culmination. If you do match your cost billing multiplier, your rate calculations are monitored regularly and compliant, your system has the accuracy and capability to identify all of these pools and allocate the appropriate indirect costs, you would have a zero over or under billing because your rate calculations are sound, your pricing is fair and in line with those calculations. You determine if you're supposed to get 8% profit, you get 8. You don't get 10, you don't get 5. So that is correcting these variances and monitoring this regularly can get to the point in the incurred cost proposal where you can potentially not eliminate completely, but manage the over or under billing to where it is non-material. So correcting variances continued. You can update your billing rates. If you calculated provisional rates or they approved rates from your previous incurred cost proposals, you're monitoring rates and you have a budget you're watching throughout the year, semi-annually. Maybe in your budget, you really planned on winning a specific contract that you did not, or you lost a contract that you really assumed that, that's going to drastically affect your budget. And you are allowed to adjust your billing rates with appropriate detailed rate calculations. You can say to the contracting officer, our expenses and our rates have changed, and to avoid over or under billing, that you may need to update your actual billing rates with the appropriate calculations and documentations to support that change. Adjusting invoices. Evaluate the impact on a contract by contract basis. Communicate with the contracting officer or customer and recalculate year to date with new rates and issue adjustments on the next or a separate invoice. Recalculate today forward and apply effective rates on remaining invoices. So this is if you do identify that your billing rates were not accurate or you had a material amount of over or under billing, there may be a need to render that over or under billing. Like we said, if it's not something that can work out in the multi-year continuation of the contract, if you truly determine that you were billing at the wrong rates, we recommend not changing those existing invoices, but year to date or issue an adjustment on a future invoice or a totally separate invoice to track and monitor those adjustments. And then the today forward, you would simply, if you had labor categories or service items, you would need to update those to those new effective rates so that that over or under billing could be feasibly smoothed out. So here is our fourth poll question. I will go ahead and get this launched.
Okay, so our fourth poll question, here it comes. How much help do you need managing your rates? So the best answers are a lot, just a little, or none, we've got this.
And this is another poll where we're just trying to, help gauge our presentation to your needs and also assess after the content if you if you had a revelation or if you've been doing it right all along. Wonderful. And again, if you would want a more detailed conversation, we have the support email, and as well as we will have some slides with some additional contact information coming up at the end of our presentation.
It is interesting because half of our respondents say that they've got this.
Okay. And that, if you've been actively contracting, participating, if you have the requirement for your incurred cost proposal, the contracting officer is probably going to be pretty adamant that your rate calculations are compliant. Even to get the incurred cost proposal marked as adequate, it's basically pass or fail. There's no scoring. That would be something, required if we have experienced contractors, mostly. And there may be room for mild improvements or adjustments or additional cost pools to better streamline or make your pricing specific. But for the sake of time here, we'll go ahead and stop the poll and get right back into our last couple slides here. So that is the end of our content. I do want to kind of reinforce the regularity, the compliance, having the system, because even if you know a compliant rate calculation or you don't get your books closed every month, outdated rate calculations obviously don't have the merit and the value that those up-to-date and current figures can provide. But I do want to take a moment here to open up for any questions or any questions we may have previously had that would be worthy to share with the group. Okay, it doesn't look like we have a whole bunch of questions, and we will move. This slide here is some contact information. As well as on our website, we have over 30 topics of free content of previous webinars and trainings that you can access. I do want to apologize again if folks have continued to have issues with the connectivity or the audio. I will be working with the support at Flow platform to ensure that everyone is able to hear and enjoy the webinars. And this one, this goes further in. This is actually an image from our website, leftbrainpro.com, with some of our additional topics and free content that are available. And our last slide here is information. We do have this monthly series. This is obviously our 6th month of the current year, so we are halfway through. But we always love in the surveys to hear any feedback of ways we could improve or better provide topics of interest or anything that may be specific to the attendees. So I believe if we don't have any questions and we have gotten through our content, we are wrapped up about 5 minutes early today. I would encourage all attendees to keep an eye out for our emails of future topics and our monthly topics, as well as keep an eye in your inbox for that CPE credit. If you did respond to 3 of the 4 poll questions, you should receive that certificate in an automated email that will come straight to the email that you registered with. And with that said, I thank you for your time today and hope that the webinar was beneficial and informative. And we will see you guys next month.
Thank you, Steve.
Thank you.